When I know the hardest part in my 10 years of trading before I finally made money, it was hitting $100,000. The hardest part was making my first $100,000. Back then, I took big losses and made way too many mistakes. But once I crossed $100,000, my account balance grew fast. Most traders repeat the same mistakes until they hit their first $100,000. So was I. I was basically donating my money to the market. The mistakes we keep repeating are really traps hidden in our trading strategy and indicators. Fix these 6 mistakes and you will reach $100,000 faster than I did. By the end of this video, you will turn those traps into edge and read the chart like a pro. When I started trading, the first thing I learned was using indicators. Moving averages, Bollinger Bands, RSI. Everyone has used these indicators at least once. When I first used these indicators, I keep it simple. I kept thinking, the candle touched the lower Bollinger Band, RSI divergence is here, moving averages point up, so why is the price falling? I didn't really understand those indicators, and the simple approach made me lose again and again. How do most people use RSI when they trade? Most traders use divergence. First, RSI divergence means this. Price makes lower lows, but RSI makes higher lows. That's bullish divergence. And when price makes higher highs, but RSI makes lower highs, that's bearish divergence. There are many types of RSI divergence, but this is most common one. Most people blindly trust this divergence. I did too. This is the first misconception that drains my account fast. Look at this chart. Divergence pops up here. Then we think, oh, divergence, trend will reverse. And we enter right away. But price doesn't move the way we want. We stop out, we wait. Then the same divergence shows up again. It dropped this much. It has to go up now. And we average down again. To recover the last loss, we buy with an even bigger position size. But the price still doesn't move our way. Divergence showing up does not mean a trend reversal is guaranteed. Price often moves not as expected, rush in, and you only make the lows bigger. On this chart, you can see divergence forming in this zone. This time, we will enter with more caution, patient, and precise. We hesitate, price learns, missed it. Should I chase? Then it drops harder and breaks the lows. So we think it broke the lows, and there's bearish divergence. Time to short. But the moment we enter, it rallies into a clear uptrend. Yeah, you can trade by relying on divergence alone. Let me show you the best way to use RSI divergence. When using RSI, confirm a clear low and a clear high first. Also look for confluence, overlapping support and resistance, and candle patterns. On this chart, price makes a clear higher high, but RSI prints a lower high. This zone hit resistance multiple times and a dodgy reversal formed. Here, a trend change is more likely. For divergence, check it on the 1-hour chart or higher. That's how you read direction properly. How do people use moving averages? Most think MAs act like support and resistance. You might say, if you're not support and resistance, then what? Fair, but MAs are volatility zones where trends hold or break. An up-sloping MA doesn't mean price moves one way. On this chart, in an uptrend, price bounced off the 120 MA multiple times. So we think, we'll get support here too, and we go long. But this time, price breaks below the MA and the trend reverses. On this chart too, MA slope is steep. We'll get support and trend up, we go long, and we lose again. On this chart, you will see countless MA breaks and trend reversals. Price hits the MA, gives a quick bounce, then snaps back and breaks through again over and over. A more accurate way is this. Don't trust one MA. Treat the overlapping MAs as support and resistance. When the 20 MA, 120 MA overlap, support and resistance often follow the current trend with a high probability. Here is the key. Don't jump in early just because you expect a bounce at the MA Enter only when price proves your direction. Break and close, retest, rejection, then enter. Price moves my way. You don't need the bottom to make money, but trying to catch the turn breeds impatience and you enter early without confirmation. Confirm first. Your profit per trade might dip a little, but your win rate skyrockets. How do you use Bollinger Bands when you trade? Tag the upper band, sell. Hit the lower band, buy. I used to trade exactly like that. On this chart, it keeps rejecting the upper band. I reshot again, and we enter. But this time, it leaps through the upper Bollinger Band and lands higher. It pulls back a bit, tags the upper band again. It'll drop this time as more get added to the short. If I short it every upper band touch here, I'd eat stop after stop in a row. Let me show you how to use the Bollinger Bands in this chart. First, confirm if your entry is a real top or bottom and which way the trend is moving. Then check the bands. Are they squeezing or expanding? Here at the top, the bands expand. It breaks the prior support and the MA with a strong no wick candle. In this case, price tends to rip through the bands, a true breakout. So don't buy the lower band here. You'd look to short. Bollinger Bands are powerful, but most people don't use them right. There are two main Bollinger Band setups, the squeeze breakout and the upper-lower band reversal. Squeeze breakout means the bands get narrow, price pushes outside, then you enter. On this chart, price blasts through the upper Bollinger Band. You can go wrong with your stop at the previous high. Don't chase, wait for a pullback, then enter for a better risk to reward. Reversal setup, take the upper or lower band, take the opposite side. When price takes the upper band, sell. When it hits the lower band, buy. These two Bollinger Band strategy can conflict. Breakout versus reversal. So how do we choose the right one? Use three tools. 1. Key support and resistance zones. 2. Strong candles, especially momentum bars. 3. MA direction and swap. With these three, decide clearly reversal trade or squeeze breakout. I will show you example next. Bands get narrow, price takes the upper band. There is strong resistance above and a wrong upper wick candle. The 20 MA was steep. Now it's flattening. When these line up, you direct to short. Up the upper band, a reversal setup. Price takes the upper band and the bands start widening. A strong candle clears the prior support zone. The 20 MA turns sharply up. In this case, you'd go with the squeeze, enter long on the breakout. Now, you can master the two basic Bollinger Band trades. You can take Bollinger Bands even further. Use them at turns, on breakouts, and inside trends. If you like my trading style, hit subscribe right now. I will only post real practical strategies you can use in the market. Beginners often bet their entire account in one shot. When you risk too much from the start, just one or two losses can cut your account in half. Bet only 1% until your win rate and risk to reward are stable. Whether it's $100 or $1,000, invest just 1%. After consistent profits over time, then scale up to your optimal size. To risk 1%, you need tiny position, like 0.1 lot on Nasdaq. That's fractional trading. It lets you trade micro size. The broker I use supports fractional position sizing, link in the description. Beginners often go overnight. That's when swap fees kick in. But the broker I use offers 0 swap fees. If you join via link below, sign up, trade comfortable without overnight charges. Most people stick to one favorite time frame, 1, 5, 15 minutes. Say I'm trading on the 1 minute chart. Here price takes the lower Bollinger Band. It bounces at prior support and I'm watching a double bottom. A hammer forms with a wrong lower wick. So I enter a wrong position. But on the 1 hour chart, watch what happens. On the 1 hour, the 20 MA is steep and price breaks prior support, clear downtrend. The bands are expanding. It's tough to justify alone here. This happens a lot. The 1 minute says buy, higher time frame says sell. So always check weekly, daily, hourly for support, resistance, and the trend. The higher the time frame, the stronger the signal. Let's talk stop losses for a minute. Most people don't set one. Even if they do, they try to re-enter right after getting stopped. And then they average down with zero plan. For example, let's say I see a double bottom, break the leg line, and I go long. But price keeps dropping. My stop level looks like a supply zone, so I start averaging down. It even breaks my planned stop by a lot, but I see sideways action and think maybe it bounces here, so I add again. Then it drops again. I'm far past my stop, and my size is big. In the end, I just average down into liquidation. On this chart, I showed the neckline break after a double top. This time, price moves in my direction. I'm thinking, nice, real reversal, so I keep holding. Then, near the prior low, it bounces and trends up. No clear take profit, I give back the gains. Profit showed up, but I didn't protect it. If you really can take a loss, try this. This also helps protect profits. When you take profit, raise your stop to lock in between 25% and 75% of gains from the recent high. Example of 50 points from entry. Trade your stop to lock in 25 points. That's 50%. If it pushes higher, move the stop again. Keep 50% of new profit. For example, add up 80 points, lock 40. Important. Only raise the stop after the candle closes. This way, even on a 30 to 50% pullback, you protect gains and let winners run. If the trend flips, you still keep about 50% of the profit. How many people can stay constant when learning any skill? Honestly, not many. In trading, the most fatal mistake is quitting after a few tries. Most people quit within 8 months. No profit yet, this market doesn't work. Trading demands consistency, at least 6 months to 8 years of focused work. Nogi started trading last July. After a year of grind, he now makes over $4,000 per day. Taijun started in May. For 6 months, he faced liquidations again and again. Now he can book over $7,000 in a week. People who get liquidated or quit usually never traded daily for more than 3 months. Most quitters don't keep a trade journal for even 6 months. That's why profits never show up. Trading is like athlete, building muscle, steady training, or no results. If you try for just 3 or 4 months, miss a few days, and say it's not working, you will miss the market's best opportunities forever. This is only trading. It's every skill, every field. I share so many trading tips on YouTube for one reason: to cut those mistakes and drill in profit-focused habits. The key is this: do you repeat and quit, or do you run once, fix it, and improve? I want everyone watching to beat their mistakes and collect daily profits. If you today helped, hit like and subscribe. Thank you.